Hello, I'm Loren Bailey, Senior Wealth Manager with Client First Capital. I wanted to take a few minutes to talk with you today about risk. As we all know, there's a certain measure of risk inherent in everything we do, whether it's crossing the street or eating at your favorite sushi restaurant. Each day, we all take a certain amount of risk to achieve a goal and get some kind of reward. The good thing is that risk is usually manageable. But many times, taking less risk means receiving less reward or a lower quality reward. Now, you might remember we learned this lesson from our early childhood when we wanted a cookie before dinner time. Should we wait and ask our parent and wait for that no? Or should we just grab the cookie and try not to get caught? The risk was getting caught, and the cost was dealing with the results of getting a cookie and a potential penalty or punishment or whatever consequence your parents had in store for you if you got caught, which, depending on the household, might have been pretty costly. It was the risk, getting caught, versus the reward, instant gratification and momentary bliss. Luckily, there is something called measured risk. In the cookie scenario, for example, you could wait until your parents were busy or in another room, and that would have greatly increased your chances of success. So the lesson here is this. With a little strategy and foresight, you can lower the risk of a penalty. And so it is with investments. When many of us invest, we are tempted to expect a specific return, right? If we get that return, we consider ourselves successful, but we don't consider the cost of getting that return and whether or not it was worth it. What if things had not gone as expected? What if things had gone the other way? When you invest, you always want to consider your downside risk. Ask yourself, what if I could have invested in the same portfolio of investments with less exposure to the danger of catastrophic loss and achieved the same or even greater return? Or perhaps a slightly lower return may have been worth it when comparing the downside. When you look at the returns of your portfolio or group of investments, you want to consider the risk-adjusted return instead of just the return. Otherwise, you are not investing, you are speculating, and that, my friend, can be very costly. To hear more about controlling risk, look us up at www.clientfirstcapital.com or contact me at the information below. And remember, investing is not gambling.